So I've been going through Palantir's quarterly conference call with Wall Street analysts, and I've highlighted one really good thing about the company's latest quarter. And also, I've highlighted one thing, and that one thing is probably the reason why the stock price fell by 14% following the earnings release. So Palantir had several great things that they reported on in the latest quarterly earnings release, even though I'm just going to talk about one positive from that quarter. I have many more videos highlighting all of the great things the company reported. That one or two bad things the company reported sent the stock price down by 14%. And I'll talk about that in the video. Why is that the case? Why did the bad things, even though there were only one or two, overshadow all of the positives from the company's latest quarterly earnings release?
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So the big positive I'm going to talk about in this video is Palantir's net dollar retention. And that came in at 124%, which was an increase from 400 basis points just from the previous quarter. And remember what this measures. This measures how much existing customers increase their spending with Palantir in their second year of service. And to me, this highlights the customer value proposition, which, if you read my book, you'll know it's one of the most important of my 6 steps that I look at when I'm evaluating a business is the customer value proposition. And the net dollar retention is one excellent way to measure the customer value proposition. And Palantir's was absolutely excellent and improving. It went from 120% up to 124%, meaning that existing customers increased their spending with Palantir by 24%. But wait, there's more. It didn't even fully capture the acceleration and velocity in their US business over the last year. They ended the first quarter with $6 billion in total remaining deal value, which was an increase of 45%, and $1.9 billion in RPO, which is an increase of 46%. So once those are fully reflected, the company's net dollar retention ratio is likely to improve even more as the company progresses reporting these kinds of results. So it was a really strong quarter for Palantir. Almost everything was excellent, except for this one thing I'm going to talk about. Right? And I dramatically highlighted this section in red just to show you that this was the reason why, one of the reasons why the stock price was down following the quarterly earnings release. Now, you may have heard a lot of reasons why the stock price might be down following the quarterly earnings release from fellow YouTubers that you might be watching, but I doubt they've actually shared this with you because I see the competition on YouTube, and most of them are not actually reading conference calls and doing fundamental analysis. They're just looking at what stock is popular and just recommending it as a buy. They found that to be a successful strategy, and so that's what they've continued doing. But I actually look at the numbers, I do the research, and so I'm going to share this with you here. In the first quarter, the company's adjusted expense was $493 million. That was up by 8% from the previous quarter, but more alarmingly, it was up by 21% year over year. Now, this was driven by their continued investment in AIP and technical hiring. So the reasons why they're increasing spending is because they see such great demand that they need to hire more people. But they go on to say, not only have they already increased spending by 21% year over year and 8% from the previous quarter, we continue to expect to see a more significant increase in expense in 2025. So more than what you've already seen. So more spending, more expense as we invest in the most elite technical talent, product pipeline, and AI production use cases. So this is bad news for investors. Most investors were hoping that Palantir could continue to support their growth with existing talent, with existing people, with existing infrastructure, not needing to spend more money to serve the growth in demand, and thereby having profits grow much quicker, right? If they need to spend more money in order to generate more money, profits might grow, but they wouldn't grow as quickly as if they could support the growth without needing to spend more money. And remember, one of the reasons why investors have been so excited about Palantir stock in the last 5, 6, 7 years or so is because how much they've improved their operating profit margin. So I go to finchat.io for these ratios, and there's a link in the description for a discount. But you can see Palantir's operating margin had jumped all the way up to 13%. It was negative 27% in 2021 and negative 100% in 2018. That dramatic improvement in profitability was a result of Palantir controlling costs and increasing revenue, thereby creating that gap between revenue and expense, which leads to expanding profitability. And so what the management is saying here threatens that expansion of operating profit margin. And so some investors became concerned and sold the stock. Now, this wouldn't be an issue for most businesses. This wouldn't be an issue if the business wasn't so expensive to start with. So Palantir is trading at and was trading at a forward price to earnings of over 200. And so when your business is this expensive to begin with, when your forward PE ratio is this high, any small sign of trouble will send the stock price crashing. It's because when you're trading at a forward price to earnings of 200, you're trading like a business that's absolute perfection. Not only absolute perfection right now, but that absolute perfection for the next 2 to 3 years, right? That's what's incorporated in a price of a stock that's trading at a forward PE of 200. So any risk to that perfection over the next 2 or 3 years will send the stock price down because it's already so expensive. So that's why, even though the company reported 18 great things about the business and only 2 things that were not so great, one of the things I just highlighted, the other one was a slowdown in the European growth, in the non-United States growth business. And so those 1 or 2 things sent the stock price crashing, even though the 18 other things were really, really great for the business. That's the risk you take when you're investing in a business with the forward price to earnings this high. That's why I haven't had Palantir stock rated as a buy, even though I think it's one of the best businesses in the world. I had it rated at a buy in 2024, in early 2024, but I had to remove that buy recommendation because the valuation got so stretched. The valuation got so stretched that I felt like the risks outweigh the benefits from this point for Palantir stock investors. Because it's so expensive, the business has to be absolute perfection for the next 3 years at the least in order to fulfill what's incorporated into this valuation. So that's why Palantir stock price is crashing, even though it delivered a mostly incredibly good quarterly earnings release.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.